greatly appreciate you being here with us today to go over some of the lending aspects, things that you see that we should know, as well as what we can prepare our home buyers and sellers for in the process, and trends that you may be seeing along the way, and changes, things to prepare us for down the road as well. So with that, feel free to take it away, Chris. Thanks.
Absolutely. Thank you, Melinda. And thank you. Sorry, I was kind of dealing with some fun technical issues getting logged on here, but I'm excited to meet with everyone. So let's, I enjoy the fact that Zoom can connect us, but I dislike Zoom in a lot of different ways, as I know a lot of us are in this industry in the sense that we love that, more tactile conversation. And so let's, as much as we can work to overcome some of the weaknesses of Zoom, I like to do so in this, and instead of having just me talking for the next hour and a half-ish, is more of a conversation to be able to talk through, and just like Melinda was doing on asking questions on what you'd like to know versus just here's a bunch of information, good luck. So let's actually, if you guys can pull up your chat, we're going to be doing a lot with that. But let's go ahead, if everyone can jump in the chat there and can go ahead and put in, I think we have a pretty diverse audience here there, can put in their years of business, so how long they've been an agent, and then let's see, if they bought a home, so years of agents, if they bought a home themselves or not, if they've gone through that process personally, and then also if they have a big lending question. So 3 things: years in business, if you bought a home yourself, and then if there's a big question of your or something you want to tackle today that you want to make sure that I touch on. That would be very helpful. So jump on there in the chat. Let's see. So chat is now open. Thank you. If everyone can jump on there, and let's see what we find there. Give everyone a couple seconds here. I don't have any Jeopardy music or something, otherwise I'd play that. All right, let's see. I have a few responses, I think, there, so I'll give you an extra second here. Oh, there we go. Perfect. Let's jump into the those who answered. All right, so let's see here. So most of you have bought and owned for the most part there, and asking some good rate questions, appraisals. Okay, so I'm going to actually copy and paste this screen so I can make sure to bring this up if we have a lot of other commentary. So give me a second here so I can make sure to address everything that's going on here. And we have a whole lot of different experience here. 16 years, Melinda? Kudos. And Chad, you didn't put your years. What's your years, Chad? 8. Sweet. A lot of experience here. So cool. We'll draw you guys as well as Dan here. So let me just get that copied and pasted so we address all possible questions. And then we will dig in. So, all right. Okay, so if I'm going to go ahead and share my screen with you guys. Let me, sorry, multitasking to make sure I get all those questions here. And I'm going to share my screen in a second here so we can dive into today's presentation and conversation. Let's see here. So, all right. guys see my screen?
Yes, we can. All good.
Perfect. All right. So just want to give a little, appreciate Melinda's introduction. Just give you a little bit of background on who I am. I moved to Flagstaff because my wife there that you see in the picture, it was going to NAU. And this is just going to be temporary. We now have 4 children and have planned that and done. 2 boys, 2 girls. And that is, we very much love Flagstaff. And this is a little dated in that we've been here now for about 13 years and work to basically, it's a good friend of mine in the business, Gary Nelson, who you guys all know. He likes to say that he appreciates that he can have a lending partner within hitting distance. And that sounds a little violent, but the fact that we are going to run into you, we are going to run into your clients, who we find become our friends and become our someone that we part of our community I have no plans of moving. We're all planting roots in the word of mouth business that we're all running, right? And to where that we take it that your success and our ability to serve you and serve our clients is very personal, right? And so so that's what we've built our basis of business on. As the last piece there, I don't like golf. We just got done with the mountain biking trip. I'm good at that type of stuff, the low hand-eye coordination. Golf, I don't do it. So anyways, that's a little bit about me. So diving in here, let's jump back in the comments. And I want you guys to tell me, or let's get, can they unmute, Melinda? Are they able to unmute?
They can,
So let's get someone to raise a hand or something, unmute, to tell us one of your best customer service experiences as you being a customer.
I just had one. I had an accident with my car, Flagstaff Collision Center, and they were fantastic. They immediately sympathized with my situation, knew that I needed to get my car back as part of my business, obviously, and they communicated throughout the entire process, which to me is huge because I'm one of those that needs to know the details all the time. And so keeping me posted along the way, they were able to move it up a little bit quicker. They knew that getting it back to me with quality was also very important. And they went over the process of what they were doing, how they were going to ensure that it was on time. And then when I went to go pick it up, it was absolutely beautiful. And it exceeded my expectations, to kind of wrap it up in a brief summary there. But I think the communication is obviously huge, which we depend on, especially from the lending aspect, if we're going to convey that over to how much we depend on y'all in financing and keeping us posted with what's going on throughout the entire process. And coming to us versus us having to come to you for asking questions is obviously huge.
I love it. Thank you, Melinda. I'm going to be pulling on that a little bit more here in a second. Anyone else have a customer service experience that they want to share? This is a participation hour and a half.
They could be eating lunch too. It is called Lunch and Learn. Maybe their mouths are full. We'll give them that excuse.
Gotcha. We'll give it one more. I'm okay. I'm a little okay with awkward silence. Put the pressure on.
Yeah.
One, if no one else wants to share.
Go for it.
Go ahead.
I had recently, my husband and I were remodeling our kitchen, and we found just a young guy who did tile just through Instagram, and we really liked his work. So we got the quote and everything, decided we'd give it a shot. Didn't really expect too much because you know how that goes with stuff like that. And he was phenomenal. He showed up on a holiday weekend. Actually, this was about a year ago. I think it was Labor Day. 7 a.m. as promised. He was meticulous. He was so friendly, so personable, which was surprising for, I think he was like 25, and he worked so hard, was, super clean with everything, was always, communicating, okay, this is what I'm working on next. This is what I'm doing next. So it was just a really great experience. And it was good to see the younger generation, because it's kind of lost these days. So that was mine.
Very cool. No, thank you. And so, as we think, and hopefully all of the rest of you that didn't care to share will share later, and also thought of experiences you've had where it's crazy to me how it's a dying thing, right? That it's, get on the robocall or, get in line. And especially right now with, with our new supply chain understanding of like place the order, pay us, and you'll get it in maybe 12 months. You know, it's customer service is a dying thing, but it is your number one and my number one competitive advantage. And so where I'm going with this and talking through, you know, we'll talk through some nuts and bolts of lending, but the idea is to hopefully make you guys dangerous enough that you know where to raise red flags, right? And you know where to say, hey, you really need to go talk to Chris about this, right? Or, you know, you are not paid hourly. I am not paid hourly, right? And so the whole idea of us being able to communicate and work together is to, you know, first and foremost, close this loan, get this client a home. But at the end of the day too, is we want another one, right? And so hopefully as we talk through everything we're doing, it's going to be a basis of knowing, you know, what are these things that could get you in trouble? We'll give you kind of high level and things to raise the red flag about. We're not going to make you into lenders or you know, loan officer assistants at this point. But going to that extra mile is when you can know what I love, and just like Melinda in her experience there, they knew more about this process, what they could deliver, where they could over deliver than she does, right? They walked her through it and they over delivered. And so just much like that process, people are wandering around, and much less market, right? We're not even going to get into
the open house.
They have goodies, didn't they?
Can you,
Nora,
you guys
can you mute? Can you mute Nora? You came off of mute there, sweetie.
I was able to as a panelist, so I just jumped on it. Okay. So yeah, so you know, it's a matter of then lost train of thought there real quick. Going into the, you know, market's a whole nother thing that you're going to have to navigate with your client. But for you to know, hey, we're not even going to go right on that home because of X, Y, and Z that's not lendable, or, you know, because it doesn't meet your financial requirements, or we'll go into this and we'll know we need to cover these bases, right? You're going to save your time, your client's time, because 80% of your clients are financing. Or I think at least right now in Flagstaff, it's close to about 75-ish. Am I about right there, Melinda? 75-ish or so?
About, yeah.
75. Cash is up a little bit more than it's typically been here in Flag. So that's kind of the standpoint that I want to come off from as we go through these, that you can learn those touch points just enough to raise your flag, call the preferred lender, whether it's me or whether you're working with another lender as a partner, use local, and make sure that you build that relationship, as it's critical. So those, if you get nothing else out of today, I want to start with those, and then the rest is just bonus. So let's dive in to the actual bread and butter things. We're going to talk about lending process and timing. We're going to talk about different loan types. And so starting there with loan types and loan mix, this represents, so our team happens to be the, you know, it shows that ego, but just so you know, we have a big, you know, our Walk and Volk is currently #1 market share in our county. And so this is particularly our team that leads that off. This is representative of loan mix. And so with each color representing a different loan type, we have everything from jumbo loans, USDA loans, FHA loans, conventional loans, VA loans. Top three, who can take a stab at top three for me here? So we're talking the big blue, the red, and the green.
I'm going to say blue is conventional. The red is jumbo, and then we start breaking it down into VA, FHA, etc.
Okay, there's one guess. Any other participants want to take a stab at it? See, let's ask. Let's see if I don't know if you're Carrie. Can you hear me, Carrie? Carrie's got some experience with title there. Are you available to comment on that?
Hi, Chris.
Hey.
Yeah, the only change I'd make would be the large would be conventional, the red would be FHA, and then probably the next one would be jumbo.
Okay. All right. Sorry, Melinda. Carrie's right.
Sorry, Melinda.
I can handle defeat.
No.
I just want to be right. So glad to know the.
No, and this is 2019, right? I haven't grabbed. I haven't updated my presentation on it.
Okay.
Sorry, and I probably, yeah, there we go. So
Would it be
definitely,
different though? Is this still trending?
I would probably guess that so this was right as of 2019. I would guess the Melinda's would be right for 2020. Very much so, as we've seen a diminishing government accepted offers, and with higher price points, definitely a much increase in jumbo, or actually, with the exception that jumbo loans with COVID did get really there. So definitely true in 2021. 2020, this could have been pretty close. Okay. So why that's important is there are so many awesome loans out there. And actually I'll go, and this is, you can see, actually go to the next slide here. So this breaks it out there for you, with jumbo being, even though that's a little further back, that's definitely much more prevalent, and those are all fairly equal shares there. Why that's important though is you're going to hear about all these different loan types. And what's important, we all have capacity, right? But there's a certain hard drive space up here, is you're going to need to know conventional, right? That is what you're what you're going to be doing the majority of the time with your clients, right? It's important to know government loans, especially when you're serving an underserved community, right? Whether you're serving a veteran and you need to know, have a little bit of basis on, hey, a termite report is required on VA loans, right? Or what's required on the FHA. Those are good nuances. USDA, if any one of you want to pick up a niche, and I say this to about every new agent lunch and learn that I do, and no one really takes it up too much, there's a zero down loan out there, in our market, which we have a ton of real estate that is eligible for it. Whether it's listed or not is another question, but USDA is a very, very big opportunity of a zero down loan. And then of course, jumbo, and then down payment assistance loans. Just looking at the mix, knowing that you'll do the most of conventional, that's where I'd recommend you focus your timing on. And we'll focus a little bit more today on conventional versus FHA, and talk a little bit more about different loan types, because whether you're a list agent or a buyer's agent, those can impact your negotiations and your ability to actually fund that property. So let's dive right into then focusing on a little bit more conventional versus FHA. As we talk about, one other quick layer of this is also talking about these guidelines as to then where they're being interpreted from. So I want you to understand that when it talks to the golden rule, let's put someone on the hook here. Dan, calling on the people I know. Dan Hakes, what is the golden rule according to Dan Hakes?
You don't want to know my golden rule, but the golden rule that's generally accepted is do unto others as you would have them do to you.
That is correct, is the typical golden rule. Now I'm going to update you guys on the golden rule of lending. And that is, those who have the gold make the rules. As we're talking through this, I want you to make sure to understand, we're talking then, all right, FHA and conventional loans, where did those come from? Why do they have certain rules and requirements? They are traditional lending paths, right? This isn't the bank of Dan Hakes or Melinda Morfin or Chad. This is traditional institutionalized lending backed by a secondary market, which then we have Fannie Mae, so these agencies that then securitize the loans, right? Because that's I'm jumping really fast through this. But that basically, that money, since I'm not just lending that up on my own pocket, I am going to, do a loan that is an acceptable loan by Freddie or Fannie, which makes up conventional lending. So there's two acronyms at the front there, or FHA, VA, or SDA. And then because that's a common security that can be sold on the secondary market, there are lots of big things that you just need to tuck away, and essentially knowing that those are agencies make those requirements, but they don't lend. They make the requirements so that that money can be securitized or transferred on the secondary market, but it is a bank and servicer who represent then the ability to lend. And so whether you're when we're talking through today, I'm going to represent the guidelines as they stand by Fannie, Freddie, conventional loan guidelines, and FHA. Now, those can change, and as those experienced agents here on the call, or Carrie or Chad or Melinda can represent to you, you might find a situation where someone says, hey, that can't happen on a conventional loan, but that means that that bank can't do it. That doesn't mean that all banks can't do it. And specifically when you talk with me about something, I'll let you know that is an FHA guideline. Or no, The FHA allows it. For instance, FHA allows new construction manufactured homes. I don't do them, right? And so just because I don't do them doesn't mean a lot of other people can't, right? So that's something to know as we're talking through these guidelines on what's an actual guideline that could kill a deal versus that's a problem with a specific lender. That's where you do get more issues with non-local versus local. Local knows their market, whereas you talk to a lender in Phoenix, they hauled water, it means something else to them. So different things to keep in mind. Let's then, as we talk then conventional loans. So with that context then, hopefully I won't last you on that, with specific conventional loan requirements. They allow for primary residences as low as 3% down. Secondary residences are as low as 10% down, and investment as low as 15% down. Basically, if you do less than 20% down, you have what's called mortgage insurance, PMI, private mortgage insurance. It's private mortgage insurance because we actually shop that out for a client, and it can be paid in a bunch of different ways. Most people pay it monthly. You can also pay out in 1 month premiums, in upfront premiums, and that can actually even be contributed in that upfront premium. You can help towards that if you wanted to provide competitive advantage or offer to buy out mortgage insurance. Lenders can do that. Interesting stuff there in mortgage insurance, and it is removable on a conventional loan. That's why it's highly attractive. They can, on the total, we're talking about debt to income ratio. The majority of you have gone through the home buying process with minor different representation that hasn't. So as you look at total gross income of a second home, or sorry, I'm reading comments and this as well. So total gross income of a client versus their monthly debt is what creates a debt to income. A conventional loan can traditionally do 45 to 50% currently of their gross monthly income can be debt, which includes the new housing payment. So that's actually fairly, as we look at other loan types, it's fairly flexible there. Property does have to meet minimum standards, which is second to cash in market, if I'm not mistaken, right, Melinda? As far as looking at property conditions, government is seen as, and even in the reality of it, government is less sensitive than it has been in the past, but conventional is still, as far as looking at any repair conditions of their property, conventional is pretty lax when it comes to that. Did you have any comments on that, Melinda?
No, I think that that's correct. And it's sometimes it seems to vary depending on who we get that's lending, as far as what some of the requirements are once we get that appraisal inspection back on some of those things. And maybe you can touch on that later. We had appraiser talk to us last week and basically told us an appraiser can do whatever they want. It's really obviously satisfying the lender. And so sometimes it's difficult to find out what's going to satisfy the lender based on some of those different loans. And so maybe that's a good point to touch on.
Absolutely. Let's talk through, I'll just finish these points and then I'll jump right into that. I think that's a good moment to jump into that, to where, they are credit sensitive. So that's where, typically you're going to want to have a client with over 700 credit. Doesn't mean they can't qualify for it. That's just where certain terms get more expensive for them. Rates go up, mortgage insurance goes up if their credit's the lower that their credit is and less optimal. And the loan limit, you can see I haven't updated a couple of things here, is 548,250 is the 2021 loan limit. So 548,250, and then we have that decision gets made on the loan limit for traditional loans every December, and loans closing after January 1, 2022 will be under new loan limits if it changes. It has changed every year for at least last 5+. As it's gone up and up and up from 417. It was from, the bubble burst up until like 2014, 2015, it was like 417 for like 10 years there. But then we started to see that move up and help us with the market so that we can get these expensive homes in conforming loans, which, will ultimately, I'll jump into jumbo here in a bit, but allows lower down payments and more attractive terms to a wider demographic of people is what conventional loans really do. And so that's where having that loan limit increases is highly effective there and really helps us all out. So just keep in mind, we'll be updating you, follow me on Facebook on December, what that loan limit will be. There was some commentary about second home versus investment. Melinda had a great comment on that as well. And a couple of things though, it is a little bit of a gray area to note there, to where really when we define with any of your clients that will call us up and say, hey, I'm thinking of buying a second home, maybe Airbnb, their intentions are kind of gray area, right? That's what gets pretty difficult with those. Primary residence, I guess, to help out there is where they're going to live at least 6 months out of the year, right? And it's within commuting distance of their job, right? A lot of people can work mobile, and that's great. If they get, we confirm with an employer that they can work remote, even though they've been living in California, right next to Apple, Cupertino, they're last 10 years, but they are allowed to work remote. They can move here and call it a primary residence as long as they have that intent. So that's much more straightforward. So that's why I bring that into the mix. Whereas secondary versus investment really comes to just as kind of Melinda was saying, if they plan on initially, restricting their access, renting out the property, whether it's short or long term, it is an investment property. If their initial intent, and that's, I guess, should back up on all of these, initial intent is the first 12 months. That's what they're signing to and getting terms of a loan based on initial intent. They sign as a primary, their intent is to occupy for the next 12 months. They end up turning it into a rental property or second home in month 22 or 23, whatever, or 3 years down the road, whatever. It does not impact their initial loan terms at all. They're just saying that that's their intent within the first 12 months. So if they say, hey, we want a second home, this is very, very common occurrence, right? So they say we want a second home up there in Flagstaff, but we'll probably Airbnb it a little bit, offset some of the costs, whether they're from Phoenix or California. We hear this type of situation all the time. If they're not filling up a rentals calendar right away or signing a long-term lease, it's typically in their best interest to pursue as a secondary residence, knowing that as they work to fulfill that intent, and down the road, whether it's 6, 8, 12 months down the road, that they start to work on an Airbnb calendar or decide to rent at that period of time, that they're not in violation of that, and they get better terms on a secondary. And actually, even so much so, if they came back to refinance and I see on their tax returns that they have some rents, but it's not a majority of the year, it's not over half the year, we can actually still refinance as a secondary property. So there is some allowances that way. It's just really that initial intent is what it comes down to. So if you are sending me someone that says, yeah, this is going on Airbnb, we'll hardly be up there, or I'm signing a 12-month lease with someone right away, we need to really advise them to go into use an investment property, not a secondary. What's at risk is if they do a secondary and they are renting it right out the gate and it showed that they violated that intent, the lender could actually call the entire note due payable. That's kind of ugly. You don't want to get into that with, it's lending fraud. So we've got to be careful with that. That's where you and I had just communicate. And a lot of times where they know, hey, yeah, I'm getting a higher interest rate, I have to put more down, but I'm going to be making more money on it. It's something that we just help clients reconcile on what their goals and needs are. Hopefully, Dustin, does that help answer your question? Just throw out in the comments if you have additional questions on that. Let's go to the appraisal aspect, though. It is a bit of a chicken or the egg situation where we as a lender require, or Fannie and Freddie ultimately, require, if they do, require an appraisal on the property, which is a third-party set of eyes that we as a lender are required to order. I say if, we've actually seen it in the last 18 to 24 months, we sometimes get appraisal waivers. It's a new thing that Fannie and Freddie, through technology evolving and data being available, that they sometimes can waive the requirement for an appraisal in general. We don't, it's very common on refinances. Right now, I bet, all the refinances we've burned through in the last 18 months, we probably only got 20 to 25% of them require an appraisal. On purchase, I see only more of 5 to 10% of purchases that we're seeing appraisals on certain conditions, whether they're putting a very large down, or if it's a friendly sell where it's not an inflated price point. So Fannie and Freddie, the value that we're working off of a price point is fairly conservative in market. Those are different factors that come into play there. But with that being said, if we need an appraisal, the lender orders it. The lender's looking for the appraiser to be their eyes on the property and on the market. And so that's where Melinda's saying sometimes it's the chicken and the egg, where we'll have an appraiser where we say, we'd really like to see this as an as-is appraisal, meaning we don't have repairs required, versus having it be an appraisal that they say, hey, we cannot close the loan until, trying to think of like a conventional condition where I had a property. So here's the fun stuff that just, you deal with over the years. Property had a site built single family home on it, and then a dilapidated structure of another home on it. We had to require that the dilapidated home, which was a health and safety hazard, was removed in order to finish that transaction. Conventional is really in the vein of like bigger health and safety, right? Other loan types can be a little more sensitive on their health and safety. But that, so as they're going through that process, that we'd like to say, hey, let's try and get it so the house doesn't have to be removed and do it as is. But so the appraiser will do it as is, say, yeah, I'm not requiring the home be removed, but here's all the health and safety as a liability, right? They want to say, here's all the health and safety things happening with that home. A conventional underwriter then reviews that and might overturn that to say, okay, I get that maybe you as the appraiser think that, they're also, appraisers know what type of appraisal we're ordering, if it's a conventional or FHA, and they're telling us the guides to that. So many times they might come back and say, hey, per Fannie and Freddie's guidelines, I have to, this structure is not safe, and I have to note that. So all of a sudden we have a condition on the appraisal. And some of that, it does become, when we're talking about gray areas in general here, some of that becomes a back and forth to Melinda's point on whether if appraiser says, no, I think we're comfortable in this, but the underwriter could overturn that, right? It could say, yeah, the appraiser wasn't sure if this needs to happen. They listed out the condition based on our interpretation of Fannie and Freddie's guides. This is what would need to happen, or how we deal with that. So, that's it could be a whole nother rabbit hole on exactly how you deal with appraisal conditions at that point, and some fixes and things that we can go through to deal with that. But hopefully that helps you understand a little bit on, we're hoping that appraisal comes back at or above the sales price and as is, so it meets the conditions of the home, meet the loan requirements we're going for, and conventional has the lowest standard, basically general health and safety to go through. Dan adds in here, I've heard the appraisal isn't an indication of the current market value, but is a reflection of what the lender can sell the loan for. Not exactly true in how you've put that together necessarily. An appraiser, their goal, and get your help as, I'm not an appraiser, and I'll get the panel's help as well here, is to reflect as best they can on current market value, with the exception that it's primarily supported by sold comparable properties. That's where it gets a little tricky, because if we put, and this market's like the best example for this right now, right? Because if Melinda puts a home to market, she's got 10 people lined up in the bidding war. Those people, sure, maybe got some comps from their realtor, but the ultimate determination of what that the price of that property will be is what a buyer is willing to pay a seller. Am I right there? So that doesn't necessarily indicate what comparable sales will support. So when I, as a lender, say, okay, if I'm doing a 3% down loan, and I say, okay, or we're doing a 97% loan and a 3% down from the client, me as the lender then, or if Fannie Freddie's restrictions say that I can only do 97% of the lesser of the sales price or appraised value, because that's what Fannie and Freddie will consider the value of the property. So in essence, so they don't want you to ultimately be underwater out the gate, right? And so that's where then there's the classic issue in how we're dealing with appraisals right now, that market value and what someone's buying that property, I should say. So we have different definitions of market value ultimately, so I gotta be careful here. What someone's buying that property for, the sales price, is oftentimes above what the current comparables will support. And current comparables, that's a changing game, right? We've actually had it, hopefully I'm not speaking too fast to it through everyone, where we've had a couple of appraisals done in the last, over the summer, and we're closing, the middle of September, and the property just got appraised the middle of August. And we talk with the agents and say, okay, that value came in lower. Here's the comp study and close at the end of the month. We'll order an appraisal update. And all of a sudden, magically $20,000 to $40,000 in value appears, just because of how fast this market is pacing. And the new sales set a new standard, right? So that's what's kind of tricky. We've had to dispute some appraisals where they've used comps from February, and comps from February are nowhere indicative of where that value is right now with where our market's gone. This is very abnormal. Welcome to an abnormal market that you just become a realtor in. And we'll see how long it lasts. Got to kind of move fast. This value is changing very rapidly. And appraisers You know, we have great local appraisers. Hopefully any lender that you're using, they select their panel of appraisers. So that's important. Is any lender you're interviewing or talking to on do they have a local panel of appraisers that they're using? And even within that, you know, not everyone's created equal. There's over 20 appraisers in Flagstaff. You know, we only use like about 6 or 7 on that panel, just because they can torpedo your transaction. So yeah, that's just something. As it comes to just understanding, you know, just working relationships again with appraiser, lender, realtor, and understanding how quickly this market's moving has been very critical. And I think that kind of gets to, if I'm not mistaken, Chad, actually, while we're on this topic, I know it's been a little bit of a detour, but I think that's Chad had voiced some questions on appraisal. Let me actually go back to that here real quick. How are lenders approaching appraisals? Meaning, is the market in place where lenders assume less value? Has the pendulum swung? You know, that's a question we can answer right here as we're at it. Is, you know, not speaking for all lenders, as I'm just one lender, but really trying to work with appraisers to understand that value and to justify as much as we can within the constraints of then Fannie and Freddie's or the different loan criteria of using comparable sales to support that, knowing what's selling. And, you know, I'd say that 50, you know, statistics are all made up on the spot, right? Or like 70% statistics are all made up on the spot. But I'd say like half of the properties that we're seeing are actually appraising. The other half are I'd say for the majority, the rest, the other half roughly, are coming in above original sales price, but under the final negotiated price, right? And so that's something that we're dealing with. I think expectation, just talking about to customer service experiences, like Melinda brought up, you know, expectation is a big factor. Oh, sorry, here. Hold on, I've got something funky going on the screen here. That when we help, you know, you're helping a client understand that they're actually, you know, ultimately overpaying for a home and that they need the funds to do it, whether they're a wealthy client and can actually do so, or whether they're having to get mom and dad involved up front and know like, hey, we have to get, you know, maybe an additional $10,000 for a shortfall. You know, that's where we're seeing things work. Primarily in market. I don't know if that answers your question entirely, but I think it's just a lot of expectation, a lot of communication, and we are seeing, you know, we're not seeing lenders, you know, when I send an appraisal update and all of a sudden that house is $40,000 more than it was 2 weeks ago with an original appraisal, we're not getting questioned on that, right? It's a matter of knowing, hey, these are the facts. Those comps sold, those comps support it. And it's really just moving through it methodically. You know, we do see a lot of out of area lenders don't move through it methodically, don't allow second appraisals, appraisal disputes. Those are where things get held up, or if they're using out of area appraisers. Those are where we see in large part a lot of issues, just because it is so sensitive. I've always said that, you know, appraising a house in Flagstaff is more of an art form than a science. When you have manufactured next to mansions. So it does get very, very tricky. And anytime you have a lower sample data, we have less homes available. So it's not cookie cutter Phoenix where there's, you know, 400 homes identically like it and 5 just sold last week. It creates a lot of sway. So we really have to be making a case for those values. Did that help, Chad? Did I answer your question? Or if you have any follow up on that, go ahead and shoot it in the comments. And Melinda, do you have any other comments that you want to put forward from appraisal standpoint from your side of things?
You know, I like the details as far as going over what we see in conventional, but maybe touch on some of the issues that we see. You know, one of the things that we see in this market, because it is highly competitive, is if as a listing agent, we're having the conversation with our sellers, conventional tends to be a little bit more of a slam dunk sometimes versus VA or FHA, or that's where, and it's not necessarily true. You can certainly have a very successful transaction with FHA and VA, but sometimes those loans are rejected in this market quite a bit. Talk about some of the things that you're seeing that they're being more specific to in regards to requirements for FHA and VA. I think those are things that we can, you know, prior to listing, maybe advise the seller to have those things ready to go should we approach a buyer with those types of loans.
Absolutely.
We don't want to reject VA or FHA. We feel like everybody is entitled to having a home. And so what can we do for our buyers to boost that and educate our sellers?
Absolutely. And I think it comes down to one of my favorite definitions of a realtor job description is risk management, right? How do you manage that risk for the seller or the buyer when we're talking different loan types and lending? So let's dive right into it really quick. So essentially, just wrapping up, conventional is great for people with strong credit, great for people with some down, and we won't go into too much mortgage insurance issue. We kind of talked about that already. So diving right into FHA. So FHA requires 3.5% down minimum. They do have government-backed mortgage insurance. Unless you put more than 10% down, it is set for life on that mortgage. It can go higher. It can go up to 56% of total debt to income on a regular FHA loan. Or if we start using down payment assistance and things with that, that changes. But they do actually, as of 2016, they do hold water. I didn't mention that conventional. So as long as it's common for the area, any loan type right now will do water haul. So yeah, back in the early days, I don't know if you remember the early days with Melinda's long experience that, deal killer. If you were an FHA buyer and we're talking about buying a home out in the country with manufactured home with water haul, it was not going to happen. So that's been really, really cool to see. It's not as credit sensitive. So that's where FHA really works well for clients that, I mean, they'll technically allow as low as a 580 FICO. Once you get technically in that 580 FICO range, we really don't see a lot of approvals though under 620 or 600. 600 to 620 is pretty difficult. 620 and above is quite doable for the most part. And the loan limit, and that actually is updated. So the loan limit is about 390 and change. So it's about a $400,000 purchase price with 3.5% down that FHA can now do. And that is a county to county loan limit. So if you're selling Yavapai or any other county here in Arizona, it is less. Coconino does have the highest loan limit. And they also, one other quick factor is they are community property state, meaning that I don't have to use the credit of their non-purchasing spouse, but any debts that they have as a couple that they purchased after or got into after marriage do play into the loan requirements. So different things, again, you don't have to memorize all this, different things that can play into the overall factor of the loan here. So just to Melinda's extent is, as you're kind of getting the feel for this client is maybe a little less credit worthy, right? Whether it's they have a lower down or they have higher debts or they have lower credit, generally speaking, and there's more stigma attached to that than is actually justified in market, that people see FHA or anything outside of conventional, and they start to think that this client might not be as credit worthy. So that's one stigma that you're going to just have to overcome. And Perman, I'm not licensed as a broker in real estate, but that's something to talk with your broker on. How do I make terms of the contract attractive to overcome that there's just flat out going to be a stigma that this person has to do an FHA, or utilizing me as a lender tool to be able to communicate to a list agent, hey, this person is solid. We're totally good to go. Have your lender call the agent and say, yep, they meet all these loan requirements. The money's going to look the same to you at the end of the day, to be able to convey that. So that's something that you might have to overcome. Or we might start seeing that FHA does have some shorter wait periods after derogatory events. Maybe that client, you might start seeing a little bit more of that with some of the economic disruption we've seen in the last 18 months. Maybe they had a short seller foreclosure, a bankruptcy, and FHA is a little more lenient on those factors, where that could be in the next coming years where we start to have to say that is like, hey, this person's a solid person, debt to income is great. They're putting this chunk of change down, but they have to use an FHA loan because of a short sell 4 years ago. Those are different things that we might start to see, or 3 years ago or something. So that's as far as then the only other aspect that comes into play outside of the client's requirements are then the loan requirements for an appraisal. And that is where, I'm just seeing if I have my next slide on that. No. So let's talk through that to where FHA appraisal is just a little more sensitive. They're gonna they've gotten better in years past, but they can call out things if if it's a Sunnyside property over here and the fascia and the exterior is really peeled, a lot of peeled paint, FHA can require that be repainted. Something we see a little really common in the last year or so is like a lot of decks. We live in some crazy weather that can really be tough on a deck. And if it's weathered and peeling paint, FHA is going to require that it be repaired. Conventional doesn't care. You know, on peeling paint, they don't see that as health or safety. FHA is a little more nitpicky about that, right? So certain things like that, peeling paint's a big one that we see on that. Or if, you know, especially if it's more of a fixer-upper, if there's cracked windows or windows aren't latching, or, you know, certain electrical issues, you know, those can come up. An FHA inspector is a lot more thorough than a conventional. They're the same people, they just look at it with a different lens. And so that's where, knowing that, my recommendation to you is understand the property that you're offering on. If it's a clean property and you can basically sell them that, right? Sell the seller their own house to say, hey, you have a clean property, this is an FHA buyer, there's really going to be no issues, right? That's a big thing. Or if you can know out the gate, hey, there are going to be some FHA issues, we're going to make an FHA offer, but here's how we're going to accommodate to still be competitive with you taking a loan that might not require those repairs. You know, what do you need to do in order to accommodate for that? All right. And there's different strategies that you can go down there. You know, talk to your broker about that if you're, you know, offering to pay repairs, or, you know, because you can basically tell them you're going to take it as is, but your loan might not allow you to buy it as is. So how are you going to reconcile that? How are you going to deal with potential repairs required typically before closing? Sometimes won't get into escrow holdbacks, but, you know, or is there a strategy with the lender based on certain required repairs that you can buy the house, get those done after? It gets a little tricky with that with FHA, but a lot of it is understanding up front. Melinda, do you have some add to that?
Yeah, a few years ago, the buyer, I represented the seller, the buyer had to pay for an entirely new roof per FHA. To get on. So the buyer didn't have to, but a new roof had to be on. The seller couldn't do it until the buyer actually paid for a roof of a house that they didn't quite yet own. In this market, are you seeing where buyers are having to do that, given it's such a seller's market? Are we seeing them come out and improve property before they own it?
So when we are, yes, so we are seeing some of that. In large part, and just like you're saying, we're seeing primarily conventional. And conventional has a little bit more workability, where if there are some heavy kind of issues like that, it is a big liability to be putting money into something that you don't yet own. So conventional has a more workability and being able to allow repairs to happen after the fact. FHA less so. And so, yeah, a lot of that is coming down to where we're having, whether it's the buyer or we've even had agents. Again, I'm not a broker to represent liability to all of you, and whether that's a good idea or not, like going out, putting some paint on the deck or helping out with minor requirements. But yeah, a lot of times that's what's kind of happening, is it's selling parties that are patient enough with it. And it's just so different, where it's just such a seller's game right now that they are being able to say, hey, you can fix it and we can deal with this. You can talk to your broker on how to legally walk through that with minimizing liability to parties, that their buyer parties is primarily dealing with those issues.
Great, thanks. And then Carrie, I had another question. If you were in forbearance, but now out of forbearance, is there a timeline that you need to wait before doing an FHA or conventional loan? Great question, Carrie.
Yes. So conventional loans, if you are, so it gets quite complex actually in the exact status and what's happening with their loan. More so on FHA than conventional, but basically if they're going to sell, right? So they own a property, they're going to buy a new one with you, they're going to sell that property, which in essence will catch that entirely up. It's a non-issue. If they're going to hold on to that property, and so when I say catch that all up, there's different things that occurred when we say a forbearance. When they got out of forbearance, did they pay that entire shortfall? I guess maybe another step back. So for those of you just joining us, folks, that were allowed a government forbearance on their mortgages, mean they didn't have to make payments. There were a lot of different structures that then happened. Some lenders said, okay, you didn't make 3 payments, go ahead and pay the entire balance now, and you'll be just entirely caught up and back on track. A lot of lenders, though, said, we'll just tack that 3, 4, 5, 12 months payments just on the back end of the mortgage. You restart your payments at a certain point, making the same payments, but now you just owe longer, right? And are making that same payment. So if they're selling and it's wiping out whatever balance could have existed, then they're good to go. If they pay that entire balance up, they're good to go, right? Whether they sell or don't sell. If they did basically kick the money back to the end and they're going to hold on to that home, they need to have 3 on-time payments made before they're eligible for a new conventional loan, whether it's a purchase or refinance. So they have to be back on for 90 days. And it's actually more like, even though they haven't said 90 days, it's 3 consecutive payments, and they can't just say, oh, I mailed him 3 payments. So it has to be like 3 consecutive monthly payments. And so that's kind of how conventional is dealt with it. FHA, there is a longer waiting period. And so that can be upwards of 12 months if they're late on an FHA mortgage. Again, the exact parameters do get into play on what has happened with that mortgage. But if they are doing an FHA mortgage and already have a home, that comes into more play. Luckily, that's going to be less typical, right? Folks that have a home already that's in some type of forbearance status, and then they're going to buy an FHA. At least right now, currently, we less typical than is typically if FHA is a little bit more a first-time home buyer. Like I said, we might see that a little bit more in the coming years, where they own a house but has some type of event. Maybe they did a bankruptcy, still own the house, and they want to do an FHA on the next house just because they can't do a conventional. So that could be more prevalent. But does that help answer your question, Carrie? All right, we'll take the signs as yes.
Yeah, no, that was a great explanation. Thank you for that. I assume we're going to start seeing a little bit of that come through 2022.
Yep. And we'll jump right into, so again, FHA is more prevalent for those folks that are primarily lower credit challenged or looking lower down. If we then jump into, let's see here. Yeah, so and lower barrier, right? There's what I have where you can see it allows 3 years from foreclosures and short sales versus a conventional is 4 years from short sale and 7 from foreclosure. And basically these are about double on conventional for the bankruptcy times and lower FICOs, so forth. So that's where the FHA is a little bit of a lower barrier. If we jump into, let's see here. So USDA and VA, we'll spend a little bit of time on those, but those, to your point though, as well, Melinda, in talking about helping clients utilize these in a competitive seller's market. USDA is very, very similar to FHA in the requirements. One of the reasons that's seen as weak is it's a zero down loan, right? And so that's where the VA as well is a zero down loan. VA is only to veterans that qualify. USDA is for outside of city limits, and they do have some tight income requirements that clients have to meet. Like a family of 4 under has to be under about 72,000 as total household income to qualify. Whereas if they have additional household or family, they can increase those limits. So that's just something to keep in mind that it's the USDA is a balance of having someone strong enough to qualify with low enough debt that they can actually buy something and within this income criteria. But that's where, again, it's coming to where people see a zero down and they might see that it's a weak qualified client. VA, likewise, right? It's zero down as a veteran. The appraisal differences are very, very similar from FHA to VA, with the exception of the VA is the only loan type that also requires a termite inspection. And so here we go again, is if you're looking at a property, you're wanting to buy, have your veteran lined up. How many, let's put someone else on the spot here. Chad, are you available to tell us how many, is Chad still with us here? No, Chad's not with us anymore. Melinda, what percentage of your buyers do a termite inspection on a property?
I try to get 100% of my buyers to do home termite and radon. That's one of my things I really press on, because you don't know. And I don't want to be selling their house in a few, I want them to live in a good quality house, no issues, peace of mind is priceless. But at the same time, if we sell it on down the road, if I didn't encourage them to get certain inspections based on, it's $120. Why would you not want to spend that money on that hundreds of thousands of dollar purchase?
Exactly. So vast majority of the time, I think Melinda is right in the same vein of the top agents that we hear and talk to of managing that liability, regardless if they're cash or a zero down loan. Most clients are getting a termite anyways. And so that's one way to sell that VA, right? If your house has termites, we'll probably have a problem anyways. And so just because we're doing a VA and the lender wants us to get a termite really shouldn't change that. And I'll do a quick bonus tip for you guys on VA. there's a difference in VA forms from a state to a national form. A lender will allow either. One of them is going to get you in a lot of trouble, and one that's not. So quick, like mental note, write this down somewhere. So a lender will take a state or national form. A state form is 2 pages, and page 1 says whether or not there's termites. So if it says there's no termites, then the lender's happy. But page 2 says all the conditions that exist that could cause termites. Things like they have, some logs stacked up that they call cellulose debris, or that they have some wood to earth contact. So, wood stacked up against, dirt against the house or something, or peeling, chipping paint or water stains. That then, because the VA underwriter sees that, they have to require all those things be remediated. So to be competitive in this market, do not use the state form. Those are all good things to disclose, to have your client understand it and to know, but when you're sending it to the lender, use the national form. It might cost you a little bit more. Trust me, it is worth it in this competitive market to say all that the national form does is it's 1 page saying if there's termites or not, right? And so if we say there's no termites, then any of the little things that they're going to go in and fix, your typical veterans, typically handy, right? They can rake the dirt away and they don't have to have this as a funding condition. They can do it once they own the house, right? That's one little trick tip for you to do. And even maybe represent to the selling party of, hey, we're able to use, we're using this local lender. They'll use the national form. Really, all VA lenders should be able to use the national form, but you can sell that, right? So we're only using, we have to get termite, but we're using national form. As long as there's no termites, we have no issue. Everything else is pretty much, very, very similar loan criteria to a conventional. We can talk, and this is maybe a little bit 2.0 conversation when it comes to that zero down aspect. So one important thing to note is FHA and VA loans do require an addendum be signed that says that they don't have to buy the house if it doesn't appraise. So that becomes difficult in this current market when oftentimes homes are going above appraised ask, or above appraised value, right? Appraisal and ask value. So that's where you cannot waive that right. And the seller still does have to sign a form stating that, yes, they can cancel if it doesn't appraise. However, and a lot of people see that, hey, that's flat out a disadvantage for this FHA or this VA buyer because we know the house is $5,000 over where it will appraise for. What the VA or FHA buyer can do is they can make statements of ability and intent. Right? There's nothing against VA or FHA guides that if you had a VA buyer that says, hey, I want to do zero down because it's in my best interest, but here's proof of funds for $25,000 that I have sitting in the bank that I'll do an extra $25,000 above appraised value, and that's my statement of intent, right? And so that's where you can do that type of thing, or you can show strong earnest deposits or things like that on a USDA, FHA, or VA that show that they have ability or funds or family gift ability. It does get difficult because a lot of these folks are fairly strapped, but that's one thing I've really liked to see recently in contracts where we're not seeing so much the flat out appraisal clause being waived, but more of defining that shortfall, right? Are you seeing a little bit more of that, Melinda?
Where people are coming in because of providing that loan. But yes, almost every contract is submitted or that we're asking buyers to submit with their offer is to waive the appraisal contingency. I haven't done a whole lot of FHA in this market, to be honest with you. So I haven't seen that, but I have heard of where agents are. But if we're getting FHA in our company, we've talked about it, people doing a letter of intent, showing and verifying, providing proof of funds that they're willing to waive the appraisal contingency, but it's not going to be an issue per the loan because we're willing to come up with the additional cash out of pocket to pay the difference. And so we're making sure that we get that ahead of time with those loans.
Absolutely. And then the ability, and I was saying as well as we're seeing then also a shortfall ability, right? To say, hey, I'm not just going to give it carte blanche of waiving the appraisal contingency entirely because I don't have, that FHA buyer doesn't have an extra $100,000 to make up, but they say if it, within $10,000, we'll make up that shortfall. We're seeing a lot more of those as well on government contracts because there is a little bit more of a defined limit. But then it's some conversation as well. And I've actually seen it work towards the buyer's advantage oftentimes. Sellers actually they are good people. They do negotiate sometimes, to say, okay, you had a shortfall of 10,000, it came in 15,000, we're still getting 10 over where it appraised. Let's make it work, right? And so there is some benevolence there from sellers that we are seeing in market. But yeah, I think just like Melinda was saying, knowing upfront, knowing ability what on the qualification side, and that requires right now in market that you guys are a little bit more involved in that than you typically be. You know, I hate feeling that we're just grabbing the client by the ankles and just saying, okay, where's all the money going to come from to make this work? But it's that reality on helping them understand, hey, this is the market we're in. There could be a shortfall. Are you prepared to make up that shortfall? Where would that come from? How can we strategize so we don't have to tell the seller the knife edge on where this works and where this doesn't, but where can we convey, where can we work to in terms? And then, as cards fall, appraisal comes in, where can we work to? And then maybe you define that knife's edge more to a seller to make things happen. Those are all very, very big things. So does that help answer at least, any other, we'll jump into the comments here.
It does, and I'll just segue off of that as well too, is that we do have the additional clause addendum that's been revised. And so just below where that appraisal waiver contingency clause is, we also have one that's more specific exactly to that states that we're willing to pay above, but only to a certain amount based on the appraisal. So the market, our documents, the state's, our Arizona Forms Committee is fantastic at revising the forms as we needed based on the trends in the market. So that's going to be something that we're going to be seeing more of based on that. So for agents that haven't seen that form just yet, take a look at it and make sure you're familiar with it so you can educate your buyers. That's a great way to kind of protect them, to show what the buyer's willing to do right up front and negotiate that in the beginning using that addendum. Yep.
And I love it. Oh, let's see here. I'm jumping into something else here real quick. But the elephant in the room, I really love that kind of, that's maybe that small transparency where you can just go into these knowing, hey, we pulled the comps. This is where I think it appraised. This is what we're going to offer you. This is, where the lending will have issues. This is how we're going to address that. Just send those offers in with as much elephant in the room on the lending side of things as you can, saying like, we're not going to just think that that you might be worried about the VA loan. No, we're going to address it, and your broker or, Melinda and different resources that can talk much more about, letters and different things. And you don't have to be violating fair housing by trying to explain things that they could be addressing in the lending, right? Or have a lender call up and help them understand, hey, this is all the VA loan requires. I've done that multiple times for people where, and actually see, here's a perfect example where I saw a client take significantly less money for a home as a seller, as a FSBO seller, there you go, always be represented, took less money for a home because they didn't want to accept a VA offer because they thought it was weaker. And we had actually both buyers. And I tried to tell it like as much as I could without conflict of interest, tell them like, these buyers are both great buyers, right? And they just said, the other one's conventional and this one's VA, I'll take less money. Right. And it was really interesting. It was really interesting to see that seller shoot themselves in the foot by probably like 10 or 15, 20 grand because of a stigma that they just misunderstood. So any other questions as it pertains to different loan types? I know that's a quick rundown on the high level at this point. Melinda, I have a couple other pieces to go into here as far as loan types though, but any questions from your side of things?
So far, I feel great. I don't see any questions here. Remember the Q&A box for those of you that are looking for asking questions. That's a great place to put it, but very thorough so far, Chris. So thank you. I think we're doing okay. If you want to continue, we've got about another 25 minutes and we appreciate your time.
Yeah, let's do another like 15 blitz round on some heavy information and then maybe do about 10 for Q&A, or is it Q&A?
Yeah, I don't have anything in the Q&A box, so you're free to proceed.
Okay, we'll proceed. Okay, so that's where kind of getting to the basis of all that conversation is getting your clients in front of a lender who you know and trust as quickly as possible is going to be your best goal. Right. I love to see that it's always the next step, right? I always like to make sure my clients know the next step, even if it is hey, get your credit fixed, we'll call you in a year. That is a next step. Or it's hey, you're qualified. These are the terms that we can work with for you. Go call Melinda and find the house. That's the next step. And so, until your clients are actually pre-qualified, if they need financing, or if they think they might need financing, until they've actually been pre-qualified, you're wasting your time, honestly. And so that's the hard part. The worst scenario I ever had is someone got gung-ho, wrote a contract with an agent friend of theirs, then came to us as a lender, and they had no idea on the reality check on what that financing was going to cost them and canceled that contract by that afternoon. It was pretty ugly, right? Pretty ugly. So as long as, again, going back to customer service, upfront expectation, and for you helping them know that the best thing they can do for themselves is take the time to go through the process and not just get pre-qualified, but understand strategically their options, strategically how these different loan types are going to work for them, and really working closely with your lending partner to understand, all right, where does this, and it's more important than ever. I'm not trying to overplay this because I'm a lender, but it's more important than ever to have those conversations, because just like Melinda's saying, when you present, you need to know how to present, and you don't want these things, you want to be as solid on your side as possible, because there's nothing worse from a negotiation standpoint for a list agent to know more than you know, and most of them are going to right now, but for them to tell you what's going to be a problem versus you telling them how you're going to overcome the problems. So that's the big piece on just different lending types and initial pre-qual. I did want to get into, let me just see what's all the different things we could jump into. Let's talk through, so a couple other pieces here. I'm not going to go into the depths. Well, I'll talk lending process a little bit. Actually, that's a good segue here at this point, is then essentially the lending process. Let's see here. Don't have a great slide for it here. So let me just start you off for lending process and timelines here is essentially, like I said, first step is pre-qualification. That's hopefully going a little more advanced though, and what we'd essentially more or less call pre-approval, right? Some people are using different terms in our market right now with that, whereas pre-qualification entails that you gather initial details, right? Some verbal information or an online application that allows us to pull a credit report. We know income, debt, down payment of at least verbally or written from a client. When I say written or just what they've typed in. But pre-approval is what we recommend all clients do. And I recommend that you actually suggest when people start that process that they go through that as well, because they're actually going to be providing the documentation that support that. They're going to be giving us that pay stub that says that they make that $100,000 that they say they make. We're going to actually get the tax returns for the self-employed person who says they make this, but always ends up reporting this, right? Or we're also going to get that bank statement. So the biggest two things that does for us as a lender is allow me to clearly state, yes, Melinda, this is their purchase price range. Or yes, Patrick, they have the money for the down, or they have that shortfall appraisal in the bank, right? The second thing that's huge in this market, and I think it's kind of funny that it took like this chaotic market to finally do this, is we check boxes. This has existed on the Arizona pre-qualification letter since I've been here, that we have little boxes that we check as lenders, say, yes, I've documented their income, I've documented their down payment, I've documented their credit. 18 months ago, correct me if I'm wrong, Melinda, the sellers did not look at those boxes very much. I didn't see a lot of it. Good listing agents did, not everyone did though.
That's my point, is that sellers don't know what they're looking at. You have to not only explain the contract and all the addenda, but also it is our job as the listing agent and the buyer's agent before I send it on over. I mean, it's a reflection. All of us should be looking at the documents, whether we're sending them or receiving them. And so absolutely. And if we see something that's funky on that, we need to call the lender. And Chris, you've always done a fantastic job of calling. I haven't had to reach out to you and I'm representing the seller and say, listen, this buyer's good to go. This is their situation. And then I can take that conversation to my own seller. So it takes all of us working together to make things happen successfully and as smoothly as possible. Checking those boxes are key as well.
So it allows, and if you really sat and thought about it too, and this is, I have, maybe the longer that you've carried, Dan, have all been in the business, I'm sorry, everyone, but you tend to lose empathy a little bit. You try to get it back, but it's like, my empathy for it is when I've done, and granted, yes, I'm a lender. You're this national average is most clients are going to do a real estate transaction 5 to 8 times in their life. We help 20 to 30 clients per month. And so I understand that I know the ropes a little bit more than your average bear. But when I'm asking, pay stubs, bank statements, W-2s, tax returns, a mortgage statement, those types of things, most clients could get their hands on those within 45 minutes, if not 5, right? And it's a matter of if you want to be competitive in this market, and you're going to take my time to drive all around in the next couple of weeks to months to year, whatever, take the time, the 5 to 45 minutes to document your file for the lender so everyone knows you're good for it, right? Because that's the world we live in, right? Those who have the gold make the rules. You don't have the money independently. You need a lender to help you with that. Give them the docs. Give them the docs, right? Just help your clients understand that this isn't anything more than a verification step and process, which actually, once they're under contract, all that needs to happen is just 2 things then. Verifications of all those aspects is the lending process. We verify with the employer, we verify with the bank, we verify with Social Security and the IRS and everything. And we verify the house, an appraisal, right? Or if there's additional, property requirements there. Some of those other loan types in different homes, whether it's government can require, we didn't touch on that, but government can require a little bit more on, a water test maybe, or a manufactured engineer certification. But basically, it's verifying the home and verifying the client's hopefully honestly given and already documented documentation. And even that's the hard part, right? Is honestly given. A lot of people don't do the job we do. So like we're talking about with a self-employed, or if with the client, if there's all sorts of situations that exist in lending where they tell you, hey, I make, $100,000 a year. Let's go find a house. And you get excited, you're going to show them a house, but it's I make $75,000 a year on the job I've had forever, and I just started a second job that makes 25, but I just started that. We might not be able to use that, right? So it's a matter of us being able to actually see, that's the difference between a local lender oftentimes and, the online or something where we've actually gone the steps of verifying, we understand the full situation. And this is deliverable, and it's going to make you look better and your client look better and give you street credit in this market instead of the opposite when you show up and say, well, they didn't do their due diligence. And now the story's changing because they didn't do their due diligence, and now you might not be able to fund the deal. So again, that's the lending process and timeline. Get the pre-qualification escalated to a pre-approval. And clients, we hope that most clients, when they connect with us, within 24 hours, we've gotten their information, their documentation, we're scheduling a consult to review the in-depth strategy and getting through the nuts and bolts of that as quickly as possible, right? And just knowing that if you don't have a lending or you're referring and you don't have that built into your process where you're making sure that they've had a pre-qualification and a pre-approval, you're really disadvantaging yourself and your client in market. The rest of the process, again, from actual, you've done the pre-approval, pre-qualification, pre-approval, you've gotten a negotiated contract with the help of your broker and your team, and then you are moving forward to a closing. It is simply that process. That's why it is typically a 30 to 45 day process. Primarily, some verifications can take time right now. I heard certain IRS verifications right now are taking like 2 weeks alone. Appraisal process right now is 2 to 4 weeks, depending on the property. Can go longer if it's more remote or unique. And so that's why it takes time to close a mortgage. It's not instant. It's just primarily based on third parties. Hopefully your lender's on top of things, the buyer's on top of things, so they aren't causing delays. It's more so going to be related on third parties. And communication, going back to customer service, is going to be critical for your lending partner to make sure they're keeping you and the buyer and everyone else in the loop. And that's the other big red flag. If you're not working with local lending or good lending, the biggest factor is you won't hear from them. And usually silence is a bad thing in this process. That usually means something's going wrong or someone's not doing what they should be doing, and it's going to cost you or your client, and hopefully not too dearly. Any additional feedback on the lending process, or any questions on the lending process, or additional commentary, Melinda?
I don't have anything in the Q&A, but I do appreciate you talking about going forward with the pre-approval process. I have that conversation with my buyers all the time. Is please go the extra step. Take the time to go through the pre-approval process. Use a local lender. The benefit to the buyer is that once we get that house, there's a lot of stress. Once we get under contract, you've got the inspections, you've got to get things taken care of. If you can go through that pre-approval process, that's going to save you a little bit of stress, a little bit of hassle, where you can focus on the house, because it is quite rigorous. And I don't, especially if people have not bought a house in the last, 10 years, really, when things kind of changed. The process of getting a loan, it's, I warn them, it's like they want the blood of your firstborn and a DNA sample. I mean, all jokes aside, but it's true. It's a lot more rigorous than what people are going through. And so you can prepare them as much as possible for how rigorous it's going to be. And even still, when they get into it, it's like, well, you warned me, but damn. So if they can go through that pre-approval process ahead of time, it's going to make it a much smoother, much easier process for them once they do get the home identified and move through it. They can focus on the home more versus getting those documents too. And I'm sure it makes the lender's world a lot more smooth as well, getting all that taken care of. And also when you're writing the contract, it's a good thing to talk about. We are dependent upon those third-party people that are involved in the transaction. So we do know that talking to the IRS may take weeks. We don't have any control over that. Focus on the things that you can control, such as let's put in the contract to get that appraisal ordered within 3 business days. So everybody has an expectation that this is when this is going to get done. If we're not reliant on these different aspects of things, put that in the contract. That'll also make your offer stronger and keep things at a nice, smooth pace as we progress through the transaction.
Absolutely. And that's ultimately where people come to you. You know, you guys, even though we're a very strong part of that, and hopefully we're making, if you pick the right partners, we're making your job easier because we're doing ours, and we're helping you maybe see some things through the transaction that need to be addressed, and we're communicating proactively on that. But ultimately, people pick you as their realtor representative because you know something they don't, and you need to do that, right? And so that's the hard part, is when you are going forward and you know, if you don't know the issues that, you know, like the worst thing, and this happens, right? Even to the best of us sometimes, is like, hey, get that addendum to the lender, or, you know, terms are changing, or, you know, communication is just so important with that lending partner, that if you don't have a high trust relationship there, it can be very, very difficult for you. Because just like Melinda's saying, if you understand the speed of this market and you know it's going to take, you're talking to experienced agents in your office and you say, hey, we need to send this contract off, and say, hey, lender friend, please record, you know, get that appraisal ordered today, ASAP, so we can hit our 30-day closing date. Because back in the day, that wasn't a big deal, but appraisers are really busy right now. And that is a factor, right? If you don't do that, and then all of a sudden your appraisal comes in late, and the lender's saying, well, it's not on us, it's the appraisal, and it came in 2 weeks late. Ultimately, you're left with a dissatisfied client. And so it really does come down to you being able to give that expectation up front, you know, be on the same page as the lender, you know, and I go so far as to say, you know, it's never, well, I'm not a broker, so I gotta be careful on this, right? So you are not in violation of any ethics standards in strongly encouraging people to get second opinions, right? Many people that you have, great clients, might say, hey, I talked into my bank, or I saw this great ad with Key and Peele, and I decided to call this lender, or, you know, online, or I use this credit union where I've grown up for years, you know, but if you're haphazardly just thinking, oh, they say you're good, you know, talk to that lender, find out, have they gone through this process? Can they send me an Arizona prequal? Do they know what an Arizona prequal is? Do they know the difference of, do they have actual docs or not? And then also making the potential recommendations of saying, hey, at the end of the day, what's most important to me is that you are in the best house and the best loan. And since it's one of the biggest purchases of your life, it'd be a great idea to maybe also talk to this local person. If you don't use them, that's great. But if you spend a little bit of time, you could be better off, whether it's in strategy or in actual terms for your mortgage. So those are things just to not take lightly, right? I find that a lot of newer agents don't set standards in their business, and they end up working the way everyone else wants them to work, which ends up working them over, right? If you set standards in your business, including them, your lending partner, your lending process, your check boxes, and maybe even, you know, you might want to go drive everyone out and get a commission, and it's exciting, but say, hey, I'm not going to put you in my car unless you have an Arizona pre-qualification letter with all those boxes checked. And while that might be some work, what's going to be, you know, that work will get you into a house. And so if you want to get into a house, you want me to be your coach in getting this big goal and getting in the right house, you know, take these steps. Other people that are not going to require that of you do not care as much about you, right? And I think those are the things to kind of consider. So that's a little bit of a soapbox. Do you have additional comments on that aspect, Melinda?
No, I think that's very valuable information, and it's part of their due diligence. And to be honest with you, if you're what I've learned, because you're right, in the beginning, we're just anxious to get in the car, get out there, to get that first step. And I've learned absolutely not. And that buyer has to put some work into it. There's got to be some skin in the game. If I have a buyer that says, oh, I don't want to get pre-qualified, it tells me how serious that buyer actually is about actually buying a house, and I'm saving my time and my money, not driving that buyer around. If I have a buyer that's committed into the entire process, and that means getting that pre-approval process and understanding what those obligations are before we ever get into step foot into a house, then I know we've got a good partnership. It is a good client, and they're going to appreciate the fact that you made this process easier for them and guided them as best as you possibly could. And that is to prepare them for the process before they ever start looking at a house. So thank you for touching on that. That's a very valuable point to be made. And agents, very much in the beginning years, we just don't focus on that. We just want to kind of get the business and get it going. So
definitely. Yeah. And there are plenty of good local lenders that would be happy to give you the time of day and helping you with that. That's, interview, find someone that meets your needs, fits, set some expectations, build partnerships. That's, ending here with the major tip there. Couple things too is, lending can be a valuable tool for you to build, get your business built off the ground. One of the things that anyone who wants to, this is my direct email. If you email me, I will send you this little flyer called Lowdown on Lowdown. The Lowdown on Lowdown. I didn't say that as good as I could have. I actually titled that, so I should have said it better. But these are, so for instance, knowing, hey, I'm going to go sit an open house. We're starting to see those a little bit more often. I'm going to go sit an open house for a more busy agent in the office, and I'd like to do some marketing, whether it's digital and there on, hey, actually, how could you buy this house? What are some ways to strategize on, getting into this with Lowdown? If it's, that first time home buyer market or home, don't use this on $1 million listing. So, that we have this little flyer I've created. If you email me, I'll send it over to you. So you do know, hey, there's some cool ways that I can market that, especially find those first time home buyers or someone that's in, I find that new agents definitely come into contact with a little more first time home buyers or Lowdown buyers than not, as you work your way up to the big tycoon $1 million listings. But that's utilizing assistance. That's what's so great about this industry is that you're only as good as the last email, memo, or flyer that you read, because it's constantly evolving. There's so much happening with, city provides certain down payment assistance programs to employment, certain employees. The housing solutions, if you guys haven't, do you guys have housing solutions come in and talk, or have you already had that?
Not to the association, at individual offices we have, but that's a good point. We could certainly do that.
Yeah, well, they're a down payment provider and counselor, and they'll do credit counseling, all sorts of different services. You should make yourself familiar with them as a resource. And so, yeah, utilizing these different, so that ultimately, in the vein of today's entire conversation, you don't have to know it all, but you can network it all, right? And you can know, hey, here's some options, and utilizing or co-branding within your licensure and that type of thing, on being able to put information out there that will be attractive in market, will get you leads, can help your clients actually get into homes, and can help our community, because that's what we really need. Is we really need some really good agents right now, right? It's easy for Melinda to write up a cash offer and have that Scottsdale buyer, wham bam, thank you ma'am, own that $1.5 million house. That's easy, and it takes some liability, and she's definitely works and chops to get it. But it's Melinda and I both know those clients that you're having to pinch $1 makes a difference on them qualifying for that house. We're scraping money from gifts, we're making it happen. Those people really need a lot of help right now. That's a lot of people in Flagstaff that are needing good agents to get into Northern Arizona before they get priced out of market. So that's kind of my ending soapbox there. Any other questions, comments, or concerns?
So far, I think it's been very thorough. We really appreciate that. And thank you for talking about that. As we're starting to see the home prices go up, and we're seeing our teachers and our policemen, our firemen, nurses, people that can't afford to live here, moving out of town. There's a concern that we're becoming another Aspen or Vail, where it's basically a town propped up by tourism alone. And so it is a concern. We want to put people in houses. We want home ownership. We know that quality of life really depends heavily on home ownership and wealth. The quickest way to wealth is having that equity in home ownership. So thank you for talking about that. And we will certainly get that on the calendar as far as having somebody come and talk about the payment assistance programs for people. That's definitely something that we need.
Great. Yeah, absolutely.
We need that probably now more than ever, to be honest with you, given the pandemic and the soaring home prices. So thank you for touching on that. And all of it, very, very valuable, Chris. I really appreciate it. I used Chris when we mortgaged our house and refinanced as well. So wonderful to work with, great guy, very knowledgeable, takes really good care of your clients. So there's his information there. Don't hesitate to reach out if you've got questions. He's always great to answer any kind of questions you have, whether you have a buyer ready to go or not. So feel free to reach out to Chris. And with that, go ahead, Chris. Is there anything that you'd like to say? Finalize?
No, thanks for the opportunity, and good luck everyone out there getting. Oh, sorry, I muted myself before I said good luck out there.
Thank you, Chris. Absolutely. Good luck to everybody. And we've got some thank yous there from the chat box. Thanks, Chris. Thank you very much. Everybody sounds very, very grateful. So if you're enjoying these Lunch and Learn series, I encourage you to catch us just about every Tuesday. If you're seeing, hopefully you guys can see my screen. I've shared it here. This is the nazrealtor.com. This is your Northern Arizona Association of Realtors website. And if you scroll down to the events and education, it'll pop up our calendar here where you can actually see what's going on. This is October. Let's just stay in September for just a little bit, Melinda. So today, as you can see here, we had the lending process. If you click on those, it'll pop up and you can actually register right there for each one of those. We've got the continued certified risk management. If you don't have that designation, absolutely get working on that. It's one of the most valuable of the 12 designations I have. That's my favorite. I feel like it's been a CYA, absolutely. And then maybe I need to refresh it here. We are having our builder updates with us on the 21st. I'm not seeing it, although I think Ventrice said that she definitely did. Let me try to refresh my page. But on the 21st, there it is, Capstone. We have David Anderson, one of your board members, coming to also talk about what community developments Capstone is doing, what they're building, some of their floor plans or locations and price points. As you know, we need inventory, so we're trying to get all those that we can, builders and developers, to come and talk to us about what's going on, what's building, what to look for, and some possible updates on what may be built in the future. So stay tuned for that. And then at the end of the month, we continue with our series, the title process. So we're kind of redoing the lending, the appraisal, the inspection, the title process every 4 months, just to kind of remind you, that these things happen. These are part of our transaction experience. There's different perspectives. We have different people come in from the lending to the title as well. So it's good to kind of get not only what's happening with current, things definitely change month to month, but also the different perspectives that we have of people in the industry. So this is October's calendar. As you can see, we've got more things coming through. And if there are any other classes, designations, speakers, presentations that you would like us to host, please feel free to reach out to me, Melinda Morfin, or contact the association directly so that we consider that and put that on our calendar for things coming up. We want to make sure that you're getting all the latest information, news, ways to increase your business and do business just better in general, because we all wear the same hat. We all wear the same realtor pin. We're all in this together in our own way to making sure that we provide the best service commitment to our clients and our community. So thanks for being here today, making an effort towards that. Absolutely. And with that, I've got 1:29. If there's not any other questions or comments, we'll go ahead. And again, thanks, Chris, so much for your time. We really appreciate it. Great presentation. And hopefully I'll see you guys in a couple of weeks for our capstone. So with that, have a wonderful rest of your day. And thanks for your time again. See you later. We'll go ahead and patch out. Bye-bye.